All right. I have with me here today a guest of the show who's been on before, but it's been a very long time and a lot has changed in his life. But in this times with COVID and with everything that's happening with the CARES Act, the PPP loans, and then how that affects buyers, I felt like it was very prudent to have somebody with lending experience on the show so we could really hear directly from the bank how this is impacting everything. And James from Lendeavor, who's been on the show, has reached out to me and or James, have you been on the show or was it Morgan who was on the show last time? Have
We
you ever been on our
both have
show?
the privilege. We both have been. We both.
Oh, so we've had two Lendeavor guests before. It's one of my favorite companies out there in lending, and so I'll let him. We have Bill and Andrew with Lendeavor as well on us. So I'll let James kind of introduce himself, talk about Lendeavor for a bit, and then introduce our two kind of fellow guests today. And I think that'll probably be the best person. How are you doing today, James?
I'm great, George. Thanks for having me here. As you mentioned, Lendeavor has grown a lot. I think we were roughly 30 folks when I joined you the first time a couple of years ago. We're up to almost 90. We went from being sort of a jump start to, I think we're maybe the second largest lender in dental today. So a lot of exciting progress. I'm an entrepreneur trying to find my way through this thing, just like you and your audience. So I'm humbled by the opportunity to contribute to this discussion. And health comes first, George, and I hope you and yours are staying safe. But we are in the beginning of an economic crisis, and I was just listening to Nigel Morris, who's the co-founder of Capital One. He's also the principal of Lendeavor's largest venture capital backer in QED Investors, and he said, in a recession, the elevator is going down, but you don't know what floor it's going to get off at. So I think before, right? I think before we get into this really financially technical conversation, it's important to understand and acknowledge that our first job in a crisis as leaders is to step up and be leaders. That means being open to the fact that you don't know all the answers, while also being very decisive. It means being open to unpleasant facts, like for instance, that right now is a time for survival. While we can hope for the best, and I really do, we have to plan for this to be a gradual recovery from a very sharp recession, more so resembling a Nike swoosh sign than it will a hockey stick. But if we do manage to keep our eyes open while we've battened down the hatches, I think we're going to find opportunities to come out on the other side of this thing much better off than we ever imagined. And we're excited and ready to talk about that too. And that's why I've brought a couple of my friends here, starting with Bill Murray, our national director of sales, who has legitimized our sales organization by bringing his 2 decades of practice finance and executive experience and also a heck of a lot of fun. And also Andrew Bennett, our VP of product. I grew up next door to Andrew since I was 11 years old. We played high school and college baseball together. He was much better than I was and went on to play pro ball. As VP of product, Andrew translates our business needs into products, which means for us, he conceives of and scopes out and builds our really amazing software with our wonderful team of engineers. He also happens to be a world-class mathematician. So we ask him to solve our toughest problems outside of technology too, like this jumbled mess of complexity we call the CARES Act and the Paycheck Protection Program. So I'm really lucky to be joined by these two as we make our return to your great podcast, George. I wish it were under better circumstances, but we're here and we're eager to help.
And I love what you said at the beginning. A lot of what we've been talking about on this show is about how to navigate through tactically all of the challenges COVID presents. And I'm happy that you acknowledge that, safety first and ultimately, lives are being lost in this whole pandemic. And so I want to spend a minute to acknowledge that, but then also that's not the purpose of this discussion. We're really here to help our listeners and the tacticians that they have to be in this moment where they step up as leaders and lead their practices through this crisis. And as buyers or future owners, you know, also the leadership that they need to show on getting into ownership at the right time and how to do that. So I'm happy that we acknowledge that. And, but at the same time, I don't want to sound insensitive, but we kind of have to shift gears where we do talk about tactically how to really navigate the situation because it presents a lot of challenges for practice owners. What do you do with your team? When do you get this loan? How do you get the loan and everything? So, James, it almost feels like such a big topic. Where do you want to start?
Well, we'd love to. I think the best way to do this is just to walk through the CARES Act from and through the eyes of a practice owner, like an actual business owner. And then, ask us questions along the way, poke some holes with us. Then I think it would be a great time to transition into some of the things people can do to complement the CARES Act on the financing end, and also get into a subject I'm sure you'd want to talk about, like, hey, what is this going to mean in the near future, in the next year, for folks who want to buy practices? So
Yeah.
that would seem like a great sequence to me, and Andrew and I can dive into the tactical parts of the CARES Act as though we're a practice owner, like I said, applying ourselves or considering applying today.
Yeah. So let's do that. Let's start with the CARES Act. Let's start from the practice owner's perspective, and let's kind of tackle it.
Cool. So obviously, this is getting a lot of attention because forgiveness is a really valuable thing. Um, there are a lot of misperceptions flying around. So, before we get into the step-by-step process of what somebody should do, I think it's important for us to draw some conclusions about this. First off, the Paycheck Protection Program, it's more and more, it's becoming more and more like an unemployment relief program for employees than it is a lifeline for you, the practice owner. The loan won't be that large. It's going to be $60,000 to $80,000 for a $1 million practice. The interest rate is, of course, great at 1%, but the payments are very high. If you take deferred payments for 6 months, you're going to have really an 18-month loan, and then on an 18-month loan over for $60,000, that's the equivalent of a $330,000 loan that's spread over 10 years. They have roughly the same payments at $3,300 roughly. Funding timelines will probably be long. The stuff going on with lenders, George, is just nuts. And then the weirdest thing is, with some recent rules, it may be worse for the business owner to get approved right away and get their funds. And we'll talk about some very recent guidance that's impacted that. Basically, we've been promoting a apply now and fund later strategy that was very clearly the most effective for practice owners, but that was really shot down essentially yesterday, a couple of nights ago. So those are our high level conclusions, and I think now, unless you have any questions, we can have Andrew launch into, hey, I'm an owner, I want to apply. Where the heck do I start?
Yeah, so you briefly alluded to something, and I want to just quickly get the answer from you, because I've been hearing, by the way, if you're ever frustrated with your bank, don't be. So I have talked to a few bankers now about this situation on the PPP loan side, and my personal banker, the one that I'm going through for this, used words I cannot say on air to describe how this process is on their end. So, I mean, this program right. should have taken 6 to 12 months to roll out, and they're rolling it out in like 2 weeks. So from the gravity of the amount of funds they're trying to give to small businesses and the timeline of which they're trying to do them are presenting unworldly challenges to everybody involved in the process. So please have forgiveness for everybody that's working on this thing. It is, again, the proper words cannot be used on air to describe how well organized this process has been. So I just wanted to start by saying that. And I wanted to ask that question that you were alluding to. So the PPP loan, it's 2.5 times if you take your 2019, if I understand this correctly, your 2019 payroll expenses, 2.5 times that is the amount that they're giving you for the purposes of payroll, rent, and utilities, that you have an 8-week period to use. And the big debate has been, can I decide when I use it in those 8 weeks, or is it when the loan goes processed, I have to start it then? And so that's sort of where we've been hearing conflicting information. That's what you were talking about, correct?
Yes, and Andrew's been on the forefront of those updates, so I think he'd be the perfect guy to dive right into that question. It's the $1 million one.
It's a great question, and thanks, George, for having us. I think, and it's sort of come out in multiple steps here. This guidance from the SBA around what is the timing here, right? I would love to be able to apply now, get approved, and know that I have sort of my place in line with these funds. But then wait to take the disbursements until I have some, as you alluded to, some sort of line of sight to bringing my staff back if I've already had to let them go, or reopening. But what the SBA has said, and this was, as James mentioned, just yesterday, is that there is a 10 calendar day limit between the approval of your PPP loan and the funding of the initial disbursement. That was sort of some new information that you can take the funds in multiple disbursements, but not particularly helpful for this situation because that first disbursement does start the 8-week clock that you mentioned. So you get approved for your PPP loan. That first disbursement, the guidance banks have gotten from the SBA, that disbursement has to happen within 10 calendar days, and that starts that 8-week period over which essentially your forgiveness metrics are evaluated.
So now, right, we're tactically looking at this. Nobody knows if this is May that we're going back, June that we're going back, and nobody knows how long we are going to be the application process is. And you don't know if funding is going to dry up and if you're going to miss out on this whole thing. So everyone's playing like, what game of chicken do I want to play? And do I want to play the game of chicken where I miss out on funds entirely, but I don't have the risk of a loan? Or do I play the game of chicken where I can't spend all of the money I'm being given to spend because I did it a little bit too safe and early? So what can you give us any idea of what timeline we're looking at for this? I mean, I would assume that the timeline of this thing is going to be pushed out, right? So my thinking is if I get my application in soon-ish, like I got mine in yesterday, then the time it actually takes me to approval is going to be pushed out longer than I think. So then the timeline of the 10 days might actually work for me and based on when I might defer versus if funds dry up, we have no certainty. If economically, politically, the situation looks different a month from now, they may not refund this program. So how are you helping people navigate that problem? It seems like you're almost deciding what would be a worse issue to have. And I don't think there's a good answer.
Well, I think the best thing we can say at this point, is we're at a craps table. If we want to speculate on what's going to happen here, that's where your guess is just as good as ours at this point, George. And so for example, like, are they going to run out of money? Like, I don't think they're going to run out of money. I think they're going to come back with this thing. But at the same time, or once they have this mechanism open and the vehicle for distributing this money, Congress can keep passing acts for let's go out with another 200 billion here or 250 billion, whatever it is. So I'm less freaked out about that, but at the same time, I'm like, I would have been like you. I'd have said, hey, let's just get this over with. I have no idea what the heck's going to happen. It's just as likely, George, that you could get your you could get your money, 20 days from now. Okay, have to pay everybody to do nothing, but be forgiven. And the annoying thing is that you did some paperwork, and then maybe you'll be eligible for another one in 6 to 8 weeks. I have no idea. Like that's as likely to happen now as it is for you to wait for a long time and time it perfectly, and maybe they run out of money. I think that's, again, unlikely, but I don't know what to tell people other than I wouldn't overthink it. Now just start taking the relief that's available to me.
So I like that advice, but now let's tactically look at this, right? You're telling me just take the relief if it's available to me. Great. I already did. I submitted my application. Let's say I get approved, right? We say 20 days, fine. Then what if I'm like, you know what? My team is on unemployment right now. I would just rather take the money at 1% than I would. Why can I not do that?
I think you can. And also, and that money is going to come in 10 days. And Andrew, my question is, what if you don't want them? What if you just decide you don't want anything? I think you can just not sign a loan contract and not get your money. But again, lenders are being forced to give you that money in 10 days. I personally don't think it's the end of the world to have a 1% loan as well.
Yeah,
Andrew,
that seems like a great thing to do during this economic recession.
Yeah, right. No, absolutely. It's not the end of the world. And you're still forgiving your salary for yourself. Probably. We said that that's open to interpretation. And you are getting forgiveness on, your mortgage, rent, and pre-existing debt, and actually, and potentially utilities. Although, Andrew, there's one of those that's not eligible for forgiveness, though, right?
That's correct. Yeah. So if you have interest on debt obligations outside of your commercial mortgage, as long as that debt was incurred prior to February 15th, paying that interest on that debt is an allowed use of proceeds, but not, believe it or not, part of the forgivable portion if you use the money for that. I think, most folks probably have some form of deferred payments, hopefully, so that would be a minimal use of proceeds at most. But yeah, still important distinction there.
So let's talk about that then. So I have to use them even if I'm not applying for forgiveness on the entire. I have to use them for that purpose.
Yeah, when you apply, one of the certifications on the app itself is that you're going to basically use the funds for the allowed uses of proceeds, right?
Okay.
So that's to discourage people that are like, hey, I'm going to borrow this money, but I don't care if it's a loan. I'm going to use it for whatever I want.
Kind of like
1%.
what I just said like 5 minutes
Yeah,
ago.
yeah. so they've thought that far ahead at least.
But then what's this February 15th date you're throwing out there?
Oh yeah, so that's well, it's actually relevant in a few ways. So first, your business your practice had to have been a going concern as of that date this year in order to qualify. Does put people who recently bought a practice in a tough spot. It's also relevant for those uses of proceeds. Any of those obligations, let's say rent, for example, your lease had to have been in place on February 15th of this year in order to qualify. So it's only obligations that you had at that point. Their thinking was stuff you had to deal with when the crisis, really started. That's what they're trying to help you with. So anything you got after that date wouldn't qualify.
So what if, so this 8-week window, is it 8-week window? So like I paid rent, right? End of February, end of March, end of April. I get my disbursement at the beginning of May. Can I include those rent payments from April, March, February that I made during crisis before I had funds as forgiveness?
Yeah, I mean, I think it really comes down to what can you document that you paid during those 8 weeks. Now, where it gets a little bit unclear, I think, is like with payroll, for example, it's technically payroll costs incurred during the 8 weeks is how the act is worded. So, with rent, I could see that getting complicated if you're like, well, can I sort of prorate rent or something, but at the end of the day, it's what can you document, right? When you go to apply for forgiveness with your lender, it's about can you show what you spent the money on during those 8 weeks, and if you can do that, the guidance is fairly broad there as far as how the lender can interpret that.
So what is the process like? So I've heard conflicting things. I've heard stuff where I need to open up a separate checking account and put all these funds in there and then have all of the expenses come from that account. I've had other people say you just spend money the way you should, and then you kind of like submitting your taxes. You submit this document that includes the itemizations of the funds when you apply for forgiveness. So what is the way that people need to be doing this in practice?
Yeah, I don't think the opening of a separate bank account, it's certainly not a requirement, but we're recommending it as a great way of record keeping, right? I think you certainly, during your 8 weeks, you should be extra meticulous about how you track money that you're spending from these proceeds, and work closely with your advisors on that. We've seen advice that, use your accounting software to help keep you organized. If there's like a class tracking in QuickBooks or something to just make sure that you know exactly where the funds are going, and that you can, again, just demonstrate that at the end. There's no requirement, interestingly, for banks to do any kind of verification. The intent of the program is to get the funds out quickly and have the forgiveness happen quickly. And so basically the responsibility has been taken off of the lenders to go and verify what borrowers are telling them they use the money for. So I think it makes life a bit easier for the lenders to really just, okay, let's look at what's been spent and how it's been spent, but we don't have to go to some other place and make sure that that's actually accurate. It just streamlines the process. So and I think the other point I would mention is there's no reason you can't draw up a very detailed plan before you take the funds and sort of have like, this is how I'm going to spend it, right? I mean, these expenses well. Hopefully, they're sort of recurring common expenses, and so if you can kind of map out how you're going to spend it and how you're going to get to that 75% threshold spent on payroll, you can really set yourself up to do it.
Oh, that's a threshold, 75% spent on payroll.
It's an all or nothing, yeah, and that's so if you spend 74% of the proceeds on payroll, you get zero forgiveness. It's a tough.
So if I spend 75% on payroll and don't spend the remaining 25%, the entire loan gets forgiven?
No, only in that case, only what you spent on the allowed forgivable purposes.
Okay, so I still have to fill in that last 25% with the superfluous stuff.
Yeah, I mean, again, the thing about this is when you apply, you're going to say, I'm going to use the money in these ways. And if you do that, again, with the one exception of interest on other debt obligations, everything you spend should qualify for forgiveness. So, and the 75% threshold, while that sounds scary, like if you don't spend that on payroll, you get zero forgiven. That sounds scary, and we get that. But The way, you're talking about 2.5 times your monthly payroll, it's basically 10 weeks. And the way it works out is that if your payroll is what you say it is, and you spend it on the payroll, you're gonna make that 75% threshold without really much of a problem. Again, you should still track it and still be careful that you do hit it, but it's not something that you have to really manipulate how you're spending the money to make sure you get there.
So now so how do we know, right? From my perspective, I submitted everything to my bank, just like, your clients are submitting everything to you. And then how do I know where I'm at, how far along in the process I am? I haven't heard anything back. I mean, again, I'm not blaming my bank. It's just like, what is this process like on the application side?
Great question. And yeah, I mean, I think it's like you mentioned, banks are they're scrambling because a lot of the guidance it leaves a lot to their interpretation, right? And that's part of the challenge. Is they're not only are they trying to operationally set things up, but they're also saying, how should we read this particular line of the SBA guidance for this particular criteria, right? It's a lot to take in. I think it's gonna vary by bank in terms of how they keep you informed. There is sort of the key point of the process is when the bank submits to the SBA your application, and they get that ETRAN number, they call it. So ETRAN is the SBA's sort of massive database of all loans, and that is kind of your getting your place in line, as I mentioned earlier, is getting that ETRAN number back. So that is one thing you could ask about is where they are in that process. But again, with how swamped they are, no guarantee of any kind of response times, I think, right now.
So James, you were talking about the fear of funds drying up being a little bit unrealistic. So can you, because for dentists, if I could accurately portray the idea of dentists, they're pretty much saying there's two camps. They're saying apply right now and deal with it not being the best time and then figuring that out later, but assuring funds, or apply when I know I'm going back with my staff and then take the risk of funds drying up. But that risk of funds drying up, we feel, is there. Are we wrong? Because I think here's what we've heard. We've heard if you take a look at all of the money available or all the money out there and the number of, I think they've said that they've underfunded this program about half as much as if they were to fund every small business that they've deemed. They've offered about half as much funding as is necessary for all of the payroll expenses out there. So from our perspective, the $450 billion is going to dry up because they've underfunded the program based on its necessities statistically. So where are we disconnecting on that idea?
I think one thing to keep in mind, and the degree to which this is comforting, I realize will vary greatly, but the intent of the program was that this 8 weeks, was designed to get you through the crisis as a business owner. And all the questions around do I take it now or later? They're very good questions and a completely understandable approach to the strategy of this. But the point was that if we're not through this in 8 weeks, if in 8 weeks you're still shut down and you still need relief, that there would be more coming. And so do you want to bank on that? That's sort of a matter of your, as James mentioned, your risk tolerance at the craps table, right? But I think it is worth bearing that in mind that there was no intent that you would need more at the end, and if that does happen, that hopefully there is more.
But I think we can all say with certainty that nobody knows when this is going to end, right?
Correct.
And
correct.
that is the one thing we can say for certain. And so I think the idea that, right, they passed this bill. I mean, they had to pass something drastically in a very short period of time. As time goes on, 2 months from now, there may not be that level of urgency that they're initially feeling. And so you're telling me that as a lender, I'm as a person who that directly affects, I'm telling you, look, I don't think in 2 or 3 months they're going to throw as much money at this thing as they threw the first time. That's my take on it. And so as somebody who's right, I am unwilling to, as a dentist borrower, I feel like if I get the money and I got to pay someone back if it's a loan, fine. But the idea of not getting anything at all, I feel is a real possibility. I don't feel like, and you know what I mean? Like the political pressure that they were under when they passed this thing might not be replicated 3 months from now, so I mean, I'm curious to hear your thoughts on that.
Yeah, I would add that just even with today's news, there's discussion about an extension of an additional $200 billion that's been discussed at the federal level. The expectation is there will be additional funds. Are there going to be funds for absolutely everyone? I think that's the biggest risk that you keep pointing to, George. And I agree with you. It's you do have some risk there that there will be people left out of the program, but it looks like the from the news today and yesterday that Congress and the federal government are going to look to extend additional capital because they know this first 350, while it was put together very quickly and it was put together during a time where there wasn't a lot of certainty as to when the country would reopen, they're continuing to add funds to this, and will hopefully continue to do that as we navigate this. And there might be even certain geographies of the United States that we'll have to focus on. When the rest of the country is open, but maybe places like New York City, Southern California, Northern California are not, there might be some local government action there. I know New York City just opened up a New York City business development grant. So there are things locally that dentists should be looking at, not just with the PPP loan to help them get through this time. And hopefully Congress and the federal government do the right thing and extend some more money, which it seems like from the chatter that you're seeing today on the news, they're looking to do.
Okay, and so I wanna shift gears to Andrew for a minute, and I think one thing that, and if you guys feel like I'm missing the boat on questions I should be asking that I'm not, then feel free to raise up stuff. I'm sort of just coming to stuff that practice owners are thinking about, but that 8-week timeline, how that's measured, how we spend funds, has a lot to do with your decision making. So you talked about having a separate account or marking all of expenses in the 8-week period, but I think there's two ways that you can interpret this. You have 8 weeks to use the funds, but do you use them on expenses? Is it the expense has to incur in that 8-week period, or is it the funds have to be deployed in that 8-week period? I think that's a very big distinction that I don't have a lot of clarity on one way or the other.
Yeah, and I think it is unclear still. There is the wording in the act of incurred, but my advice would be to be able to demonstrate that you actually deployed the capital during the 8 weeks, just to be safe. I think there's if you can do that, there's no case that anyone can make that you didn't spend the money during the 8 weeks as it was supposed to be spent. So there are obviously some nuance there around maybe expenses that go towards the end of the 8 weeks and maybe they roll over a bit afterwards, but again, I would urge people to spend the money during the 8 weeks and to be able to document that you did.
Okay, so it's about
George. I got a question for you too.
Please.
What's your feel among your community of practice owners? Are people kind of okay and looking at this as a form of optimization? Like, I want to optimize getting back into business,
yes,
almost like a retirement match? Or are people saying, holy smokes, I need the money? I'd love to hear that from you.
So I don't want to speak for all practice owners, because I'm sorry if there are those out there that genuinely need this capital to keep their doors open. But most of us are in the financial position where for the next 3 or 4 months, we should be okay if no capital arises. And so I'm sorry if I'm coming off insensitive to anybody here. I am using this PPP loan, in my mind, it's just a way of supplementing lost income. And it's a way of sort of, I might have some months with losses or no profits, but then this maybe a couple months I can operate and have this grant potentially pay a lot of my expenses. And then I have mega profitable months that sort of make up for those months that I lost money. And I'm at some sort of net wash in the whole COVID crisis. I think that's the way I'm looking at it. And hopefully there's enough successful practice owners out there that can look at it in that same way. But, if you think about it, like if I'm a solo practice owner, and I don't have very many fixed expenses. I sent my employees home. They're on unemployment. And I'm sitting here. Realistically, my break even in these months is like $10,000 to $15,000 a month. Mm-hmm. And, I might make, I don't know, I want to speculate, but, let's say you make $400,000 a year and you're operating at a break even of $10,000 to $15,000 a month and not working. It's kind of, that's a sustainable situation for a while. And we're not restaurants. We're not in the situation where, it's like, if I don't get this money next week, I'm toast. We're just trying to use this situation in a way that leverage it in a way that puts us financially, in the best situation moving forward. And so, yeah, we're more interested in the game of chess than we are in the game of survival. So that's my take on my audience.
That was my sense as well. It's good. It's better hearing it from you than speculating myself. But yeah, that was our sense.
So that's why a lot of us are wondering, and right, there's so little. I think it's funny because I entered this interview thinking, oh, good, we're talking to the bank. They've directly communicated with the SBA. We'll have the answers. And what I'm getting from this is nobody knows, not even the SBA, not even banks. And I think it's just embracing the uncertainty behind this whole thing.
Yeah,
is really the way to go, because I think the search for certainty is going to be a wild. You're not gonna find it.
Totally. Numbers put this in perspective, and when you think about in a given normal year, the SBA transacts on about 60,000 applications annually. In this crisis, they're going to receive. Numbers as of this morning were over 350,000 applications. So when you think about a government agency that's set up to perform at maybe 60, maybe 80, maybe 100,000, they're going to have 3 or 4 times that over the next several weeks. No one was prepared for that. And I think the way that you saw it rolled out up until Friday night, banks were still getting guidance and direction from the SBA at 11
the interim
p.m.
instructions
on the East Coast. Yeah, exactly. I think, and Andrew, correct me if I'm wrong, I think the application even changed 3 times over the weekend before it was finally, ready to go Monday afternoon. So even banks that were preparing and wanted to take the application changed on them in the last minute. So it was just seemed like what you would typically see from something that was, well meant. It had good meaning behind it and good intention, but the execution of it being so fast, so ramped, because it had to be, was certainly not what you would expect from a traditional banking experience or lending experience.
George, the way I'd put it is the uncertainty that you're feeling as a practice owner on whether the money is going to run out, whether you're going to get forgiveness and all that. Multiply that by probably 10 if you're a lender. They didn't know they didn't know how to get a guarantee. Most of these loans are SBA loans are often sold in a secondary market. The secondary market option completely evaporated the moment they said it's a 1% loan over 2 years instead of a 4% loan over 10. So banks were like, oh my gosh, I don't know how to get a guarantee. I don't know how to get this off of my books. I sure do not want a 1% loan on my books. And now the Fed is saying that they're going to buy all of these, but the mechanism for that is still forming. So they're like you said, they're getting $2 trillion out in a stimulus bill and figuring out how the heck they're going to deploy it and assure people that they're going to get their money back. And it's still not done.
So now I'm a big fan of guesstimating. And I think for me in this crisis, part of the annoyance that I have is that there's a lack of guesstimating going on. And there's too big of a reliance on false or I guess kind of unreliable data. And so let's, for our audience, try to guesstimate this, right? Nobody's going to hold what you say as fact. But if I'm looking at the situation, the SBA is clearly unprepared on handling the level of volume that they're seeing. So naturally, that will just naturally push your timeline out, even if they've tried to streamline that process. So in a practice owner's perspective, even though you have to use those funds, you don't get to choose when. I feel like the amount of time it takes to get funds will be longer than people think, and you almost get that deferring time period in the disorganization of the process without actually having to have it be formally written as a rule. Am I understanding that in a way that you guys agree with, or am I saying something that you guys don't agree with?
I'd make the same bet.
Yeah, I would as well. Yeah.
Right. And we're totally guesstimating. We're taking a risk, but right, getting your spot in line, getting that ETRAN number is very important, because that's your ability to say, okay, I'm spot number 352,402. And if funds are not used before that, then great, I get funds. So do we feel like we've concluded? I want to transfer while I still have you guys for like the next 10 or 15 minutes. I want to switch gears to buyers' perspectives on this whole thing. whether it's the multiple practice owner or the single practice owner who's looking to become an owner. Do you guys feel like there's something we've left unsaid with the lack of information we have currently on the PPP loan, or do you feel like we've kind of addressed some of the big hitters?
No, I think we've hit enough on the CARES Act, the PPP loan. I think the one suggestion we would always make is, there's a lot of LinkedIn and Facebook experts out there today. Just make sure when you're doing your due diligence on those two programs that you're getting information right from the source, from people that are reputable, that understand the program, and make the right decision for you and your business. To shift gears to the buyer's market today.
Can I wait, Bill? Now that you said that,
yeah, go ahead.
Can I? So
the ADA, talking about the ADA?
No, I'm not going to talk about the ADA, and you don't want me talking about the ADA. So so I was talking to brokers. So my first call after this whole situation was to dental brokers, and I wanted to say, what's going on with the market right now? And they were like, you know what, things are going great. It's the banks they're eager to lend right now. And then I call a bank and I hear a completely different story. And so I think segueing, anybody who's interested in lending and how it's talk to a bank, not anybody else, because that is, from talking to banks, I've not heard that we're eager to lend to new practice acquisitions in this time. And so Bill, can you expand on that?
No, totally. I think you'll see a broad range of responses from banks, and you can kind of segment them into, large national, banks, national lenders. You've got kind of your regional lenders, your sub-regional lenders, your local banks, and then you have obviously financial technology firms like ourselves that have the ability to work with multiple capital partners and diversify. Typically, what you'll see in a response from a large national bank in an event like this, with a looming recession, or a recession that we're actually right in the middle of, and as sharp of a recession as it will be, is they will typically have some large sweeping policy brushed across their entire lending guidelines and policies and procedures. So it's not uncommon. You can point back to 2008, 2009 during the financial crisis. It's not uncommon for a large lender to make these broad sweeping strokes across their entire risk policies for their entire business units. And those get applied to healthcare loans, to small business loans, to general loans. And typically it's for the negative. They will pull back a little bit, typically.
So they're becoming more conservative.
Absolutely, yeah. So
Okay.
you'll see restrictions on working capital, restrictions on loan to gross calculations. You'll see some restrictions on liquidity and how they lend to borrowers and how they look at borrowers and borrower strength when they come to the table and apply. So you would expect to see that in some cases. And then some of the smaller lenders that are in the space will have different reactions. They won't have these broad sweeping policies across all of the organizations that they service and all the industries that they service. They have the ability to be a little bit more speculative on what industries they service that still will perform. So you might see less of a pullback from smaller regionals, unless they've had issues in other areas of their bank. So that's the other part of the recession that happens. So you've got the initial response from banks to say, well, let's take a step back, figure out where we want to lend, how we want to lend in this new environment. And then if losses do occur, if this recession is sharp and losses do occur, then if they occur in one bank specifically, or multiple banks, or if they're across the whole echelon of an industry, you'll see a major pullback from either those specific lenders that took a loss that couldn't really afford to, or if it's an industry-wide phenomenon where there's multiple losses and loss rates go up across the board, you will see an industry response where the industry that service, the banking industry that service that industry, pulls back a bit. That's why I think where Lendeavor is set up is great, because we do have multiple capital partners with multiple appetites. We don't have to be broad stroked across the entire portfolio, and our portfolio continues to perform extremely strong.
So here's the thing, though, with dental, right? We're only talking about one industry here, dental, and we're all closed. I mean, we can call it emergency only, but that's like 10% of what we do, if that, So for the most part, our audience is at a revenue standstill. And so if I'm a buyer who's, we have a lot of fired associates right now, right? A lot of associates lost their jobs. And so they're all, let me use this time to buy a practice. And let me go hunting opportunities. And there's a lot of sellers right now. They're saying, I really want to get out of this thing while it's stressful.
Yeah.
So what does that situation look like? Because what I've been hearing is that there's almost like a pre-COVID and post-COVID valuations for practices. And you can't really use pre-COVID numbers to value a practice post-COVID. So how are you guys looking at that situation moving forward?
Sure. Well, I certainly can speak for Lendeavor, and we haven't had any material changes to our credit policies. What we what we have always predicated our underwriting on is logic and common sense, right? So yes, if you can show me that the practice did have this expected downturn, that it was closed for 30, 60, 90 days or more, but then once it opened, those patients came back to the practice and you can show me demonstrated production, you can show me a borrower that, yes, they lost some cash in their personal financial statement, but since they began working again, are kind of right back up to their normal savings rate and are replenishing that rainy day fund that they had to go through because there was an extreme rainy day. Those are borrowers that we will absolutely lend into, and those are practices that we will absolutely look to approve. I can't speak
how
for all the
long
other
of a
lenders out
period
there.
do you want? Is this a year or 6 months, 3 months? How long of a back to normal financial statement do you need to feel comfortable lending on $1 million office, for example?
I mean, right now we're looking at our approved transactions. So transactions that moved into this event and were approved to close and were scheduled to close in late March, April, or May. With those transactions, again, we're not applying wide sweeping policy across all these deals, but we'd like to see on an acquisition loan, the practice become open and some level of production that shows that it is going and growing back to where it was.
That's all you need.
It doesn't have to be 100% dollar for dollar. Show me that patients have returned. They're at 60, 70, 75% or more in production capability from where they were pre-event. And tell me the story of how you prepared going into this event, how you navigated through it, and then how you're executing to your plan going forward. And if you can articulate that to your lender, articulate that to us, we will absolutely look at that as a transaction that we feel comfortable continuing to fund and borrow.
I love that.
Yeah, absolutely. Thank you.
Yeah, George, our philosophy is our feelings on the dental industry remain unchanged. We really like the 10-year outlook. So we're going to use common sense on a deal by deal basis, and we're going to support people with structure as opposed to arbitrary rules where we can't look at something like, how's production doing in this month that you've opened up? We're actually going to take a look at that and give you 6 months deferred because we like betting on everybody in this industry as long as they have a support system with the structure like 6 months deferred or something along those lines.
And I think here's the thing I'm telling buyers is right now we have all of these sellers with nothing to do. So they're free to take your calls and meet with you and plan this out. And you can potentially negotiate a discount on a practice because of this situation. I mean, This is not a situation where sellers are choosing between 3 or 4 different buyers. And so I could potentially walk into a practice at a discount. And if there's a lender willing to do that with me, then that's a great situation for a buyer where if you can come in at the 60% upswing, 70% upswing, then you could, I could probably talk a seller into taking a lower valuation to get out. I'm fairly certain I could do that.
As Warren Buffett would say, be greedy when others are cautious or scared. That's what we talk about coming out on the other side of this thing with great opportunities. Bill, I don't know, are we seeing a move in the market just yet? I think it's probably a little early for us to see how prices are changing. It's probably happening. Bill, curious to hear if you've heard, you have seen it already. Got it.
Oh, from brokers? Yeah.
Yeah.
Yes. That has been.
There's absolutely going to be a change in price, especially in areas of the country that the economy is certainly reliant on hospitality industry, hotels, restaurants, a large swath. Like you think of a place like Las Vegas and places like that rely on hospitality, travel industries to kind of prop up their economy. You'll also, what's yet to be seen, I think, is the reaction from private equity-backed DSOs, because that's what's really been driving prices up on practices the last several years. So those PE firms that were really looking to make their 5 or 7% in the next 5 years are now realizing after this 90-day event they will not. Are they going to pull back their funds from growth and they won't be there bidding on these practices, or will they try to buy their way out of this incident and acquire more practices? I think you'll see a different reaction from some PE firms there. But that's one of the pulses that I'm trying to look at over the next 90 or 120 days is what's the reaction from some of those acquirers that have been out there that have been super aggressive, that have been bidding up practices. Does that continue? That's yet to be seen, but that will really determine. This is
exposing all of those that are over leveraged right now.
Yes,
that's right.
And so there's been a lot of over leveraging going on.
Many of them lose their. Many of them are also the double whammy. George is many of them are losing their eligibility for CARES because they're funded by private equity firms as well. So a lot of things going on there to where you're going to see blood in the streets, I think.
Yeah, I have been. So Bill, I was looking at the same thing, because as a private buyer, you're very up against that guy that can pay top dollar tomorrow, keep the seller on, all of those things that those groups offer. And everything I'm seeing or hearing about from that side has been very contracting, at least to get through the crisis. Past crisis, I don't know how they handle it, but I think there's been a lot of over leveraging.
And what you're going to see from Lendeavor is we are looking for ways to creatively tailor products and services to our clients, that when this event ends and we exit out of this, what could we be doing to provide changes to product, enhancements to products, to take a tailored approach on financing to help people ramp up faster. So an example of what we're doing right now is we just recently launched a change to our refinance product. We are now offering up to 6 months of deferred or interest only period with your 120-month term. So you can restretch your debt to a new 10-year term and then add an additional 6 months of interest only or deferred payments to help you have excess cash flow. When you put that in the numbers, for $100,000 that was on a 60-month term, if you were to stretch that over a 10-year term, the savings equates to about $800 in monthly cash flow per month. And then you add the 6 months interest only deferred on top of that. That's great. We've also changed our policy on working capital for refinances. So now borrowers can get up to $200,000 in working capital to help seed their practices, replenish their finances for their business, and also help replenish the finances for their personal life as they come out of this. Obviously, $200,000 is the max. That's not something we would potentially lend on a $700,000 practice. But if you've got a large 1.2, 1.3, $1.4 million location, we absolutely would. For those smaller practices, those general practices that are in that 700 to a million range, having an additional $50,000 to $100,000 in working capital could be really meaningful right now as you pull yourself out of this event and replenish and recapitalize your business and your personal life. We're also doing the same with acquisitions as well. So we've always had a 6-month interest-only deferred period for acquisitions. I think now people will be looking for that as a more accepted general practice from lending, and we're here with the doors open, ready to lend that money out.
Bill, I'm kicking myself for trying to do this as a 2-part episode where we talk about both things at once. I think this is a whole episode in and of itself where we talk about this. So I got to wrap up for today, but can I invite you back on The Pursuit of Ownership? It's our pre-owner show where we talk about this in more depth, and whether it's refis or new acquisitions. I think, do you have a timeline maybe when we have a little bit more clarity on the situation and an end in sight? I kind of want you to I want you to come back on and tactically speak to our buyers about how to get in ownership using this time, because I don't feel like we'd be doing it justice trying to do that right now.
That's great. No, I'd love to do that.
Well, I really appreciate you guys coming on. Do you guys have anything else you want to add before we kind of wrap up?
It's just a real pleasure to be here. I'm glad that you're doing well, George. Stay healthy, stay safe. We're all in this together, and it will pass.
Yeah, thank you guys so much. This was awesome, and I really wish I had more time because you guys are, wow, I feel like I could keep going, but we'll wrap up for today, and we'll definitely have Bill back on The Pursuit of Ownership.